All right, good morning, everybody. Thanks for coming to day two of real estate taxes, right? So yesterday we talked about real estate property taxes. Specifically, we spoke about Proposition 8, Proposition 13, and Proposition 19, right? In summary, Proposition 8 allows you to have a temporary reduction in your property tax assessment if the market goes down and if the property assessment is above market value of your home for that tax year. Okay. Proposition 13 limits the increase of your property tax assessment by no more than 2% per year on an aggregate schedule. Okay. So, and then Proposition 19 allows someone who's 55 and over to move their property tax assessment from any property in California once they sell and then buy another property. Okay, so that's the portability part of the tax assessment. So again, that's Proposition 19. Now, we learned that they can do it they can transfer the property assessment to their kids if it's owner occupied by the kids, and they can even send the property tax assessment to their grandchildren. That's part of all Prop 19. Okay, so make sure you guys know understand what those are. So again, Prop 8, temporary reduction. Prop 13 is the limit of increase to no more than 2% per year. And of course, Prop 19 it gives you the portability of that tax assessment. So you can transfer it to another property. Okay. So there are rules for it. So learn about it. Okay. All right. Today we're going to talk about understanding capital gains tax or the benefits of buying, selling, owning real estate. Okay. So what do you guys know about what are the benefits of owning real estate? What can you deduct? Right? Does anybody know? What can you deduct?
Taxes.
How much?
Well, I don't have a number for that though.
Right.
Ten
Okay.
thousand dollars? No, $10,000, I guess.
Right. Okay. Good answer. Okay. All right. So what is tax deductible, right? So if you look at this, what is tax deductible? Interest costs up to the first $750,000 loan amount. Okay. So if you get $1 million loan, you can only deduct the interest on the first 750. You have to do the math. Okay. Your accountant or whatever software you have should do the math. Okay. Property taxes, only the first 10,000. So if you buy a $2 million property, your taxes are about $25,000 per year. You can only deduct the first 10,000 up to. Now, if there's some other deductions you're taking, this may be lessened, but technically this is what's deductible. Okay. And this applies for first and second homes or what we call personal use homes. So total. For most of us, this is taken up by our one house, right? So which means that if I have a second house, right? Let's say, like for instance, we used to have a house in Newark and then a house in Half Moon Bay, for a while, or we had multiple properties, and we were able to deduct $1 million, up to $1 million loan on each of them. Okay, that was the old rule, and we had no limit on the property taxes. Okay, in 2017, this all changed. Okay, and that's where the limits came about. And so that's why we converted a Newark house into a rental. And now we're living just in the Half Moon Bay property. But because our loan amount is more than 750, we can only deduct the interest on the first 750. And then the taxes, it's almost more than 10,000, but we can only deduct the first 10. All right. So the benefits of this is now, since we converted the Newark house into a rental, it's no longer a second home or a third home, right? We can deduct all the interest for the full loan amount, all the taxes completely. We don't have any HOA, but if it was a condo or we have HOA, that's fully deductible. The homeowner's insurance, mortgage insurance, if any, maintenance, anything that has to do with the investment property, you can deduct, right? Every time I have to drive there to look at it, to talk to the tenant, that's deductible mileage. So we'll talk about that tomorrow. Okay. So again, with regards to your primary use, only the interest on the first $750,000 loan amount, no matter what the interest rate is, but it's the interest on that first 750 and the taxes on the first 10,000. Are we clear? So what's the difference, right? Some people says, first home, second home. Typically, there's primary use homes, which you use it for more than 15 days out of the year. That becomes a primary use home. There's what we call a rental property, right? We all know that, or we rent it out for monthly, yearly leases, things like that. And then there's the Airbnbs. right? The Airbnbs are treated just like an investment property as long as you don't personally use it for more than 15 days. If the moment that you use it as for more than 15 days, it now becomes a second home. So don't use it for more than 17 or more than 15 days. Okay, guys? Now, some people said, well, what about those vacation rentals I have in Lake Tahoe? Right? It's the same process. You get to use it for personal use for 15 days. Everything else, right? Throughout the year, as long as it's being rented. mm, Okay. Again, it doesn't have to be rented every single day, just like monthly rental, things like that. You can do weekly rentals, things or weekend rentals, right? Like an Airbnb. That is an investment property. So all the expenses are tax deductible also. Okay. So what you want to have are personal use homes, which is limited to the 750 loan amount, the 10,000 property taxes, and then you should have rental properties that you're not staying there for more than 15 days. Because the moment you spend more than 15 days there, it now becomes into this limited 750, 10,000. Okay. Are we clear? All right. So you should not have a second home unless you're rich, right? Unless there's no interest loans or you don't have a loan on it or something that you can't deduct, right? Because most of us, like I said before, is this 750 limit, the 10,000 limit is eaten up by our first house, our primary house. Okay. Any questions on what you can deduct? We're good? All right. So what happens when you sell, right? Well, when you sell, right, you have a gain, right? If there's no gain, there's no tax. If there is a gain, profit, right? When you sell a stock, there's profit, right? So in this case, in real estate, whenever you make money, right, you're supposed to pay taxes on it. So let's talk about the primary residence, right? So in the primary residence, okay, you have to do the math, right? Sales price minus expenses minus how much you bought it for, and then you can even minus whatever capital improvement. And capital improvement typically talks about square footage or there's a substantial increase in value, not maintenance. Okay. So if you have to replace your roof from a composition to another composition, that's maintenance. But if you're upgrading it from a composition to a 100, like one of those 50-year-old tile roofs, right? That's capital improvement because you're increasing the value of the property. You put a pool, that's a capital improvement. So that adds to your basis. Okay. Now, in order for you to get the better treatment, you need to hold on to that property for at least 1 year. Okay. If it's less than a year, you're going to be taxed at ordinary income. So whatever your tax rate is for your income is, that's what you'll be taxed on. Okay. So long-term capital gain, again, that's 1 year or more. You'll be taxed either zero for nothing if you don't have any profit. It's either 15 or 20% depending on your income and filing status. Okay. Now, what are the capital gains tax rate, right? You got the federal up to 20%. So it's either 15 or 20. There's nothing in between. California starts at 7.3. Then, depending on your income, it could be 8.3, 9.3, 10.3, 11.3, or 12.3, or 13.3. And they're trying to make this 15.3, okay, for anything above a million as far as income is concerned. Now, this Healthcare Tax Reform Act, we used to call this the Obamacare. So whenever your profit and your income goes above 250, you have to pay an extra 3.8%, okay, to pay for healthcare. Then, all right, so this is what we have to look at initially, okay? Now, this is all primary use homes, right? Now, how is it calculated? As I said earlier, you get your adjusted cost basis, which is the original sales price plus any capital improvement, not maintenance, right? Capital improvement. Okay. Let's say you have, you have to redo your front driveway. That can potentially be a capital improvement because you're substantially improving the property. Okay? To calculate gain, right? Sales price minus basis minus closing costs equals your net gain, right? So once you have your net gain, right? So let's say you bought a house years ago for $500,000. There's no, you're selling it for a million. Your gross gain is 500 minus expenses. Let's say 50,000 Any capital improvement, let's say nothing. So 450 is your taxable gain, right? So now what do you do with that? Right? Well, section 121 says if you've lived there, no age limit, no income limit. If you've lived there 2 years out of the last 5 years, right, you can deduct the first $250,000 of gain per person, 500,000 if you're married filing joint, right? So just remember the 250 per person, whoever's on title, right? If you're married, spouse, filing joint, your spouse does not have to be on title, and you can still get the full $500,000. Okay, so 250 per person, tax free. So every 2 years, you could be selling a property and getting $250,000 of gain tax free, right? Now, I know people have done this every 2 or 3 years in the last couple of years. And because the market has cooperated and, because of price points, they're able to pocket $250,000 and some $500,000 every couple of years because of this because of this Internal Revenue Code Section 121. Okay. So just like you remember Prop 8, 13, and 19 from yesterday, you got to remember section, IRC 121. Okay. Because this is primary residence, right? Later on, I'll talk about 1031 exchanges. We'll do that class probably in a couple of weeks when we do investment classes. So in this case, it's primary use homes, right? So $250,000. 121, just remember that, okay? 250,000. And again, you have to live there 2 years out of the last 5 years. Does not have to be continuous. You just have to be able to prove it to the IRS if and when you get audited, right? Just like if you get caught speeding, it's your job to, if the police officer says, do you know what you were doing, right? Don't ever say I was speeding, right? Just say I don't know what I was doing, right? So you can claim ignorance, but ignorance is not a excuse against the law. Because if the cop says, "Oh, look, you were going, 30 miles above the speed limit. Here, I have you on the radar," right? So they have proof. So now it's your job to disprove it or not, right? So again, if you say you've lived there 2 years out of the last 5 years, how will the IRS know? They'll look at your tax returns. They'll look at probably your driver's license, where you vote, ask your neighbors, look at, they'll ask probably, hey, can I see some PG&E bills, right? Any bills going to this address, things like that. So they have ways of finding out if you've been living there or not, right? So I think that's pretty much it. Okay. So any questions on that? So we've covered pretty quickly, what is deductible, what's not deductible, right? Um, I'll touch on 1031 exchanges a little bit later, but is there any specific questions on what you can or cannot deduct? Oh, so you guys are experts. So again, remember, $750,000 loan amount, 10,000, for property taxes. Again, those are primary use. For investment property, where you're not using it 15 days or more, everything's deductible. So it's pretty easy, right? Okay. So now there are talks right now.
Correct. Yeah, hi.
Oh, no, sorry, there are talks right now to increase those limits, and there are some talks to lower those limits, right? These laws, the tax law right now is good until 2026. Okay. So right now they're talking about the budget, inflation, all this stuff, right? Hopefully they renew what we have already or improve on it, right? Hopefully it doesn't become worse. Okay. And comes from the federal, because whatever happens on the federal side, California just follows in turn. Okay. So Saranjit first and then Varsha. Saranjit?
Yeah, hi. So, for the investment property, you said everything is deductible, including that 10,000 and 750 interest, right?
Any interest, if you have a $2 million multi-unit, all the interest is deductible. Remember, the interest on that loan amount. Okay. It's not
Up to
okay.
750, right?
Yeah. So whatever the interest on that $750,000 loan amount is deductible. Okay. The interest only. Okay. And the taxes up to the $10,000 amount. Are we clear? Okay. So that's why you should never have a second house unless you're rich. You want it. Remember, if it's a choice between buying a primary and buying buying a rental has bigger benefits. The reason people buy primary is number one, they don't want to deal with rentals, or they want some stability for themselves, right? I know I have clients, even our kids before, they didn't want to buy their own property, but we taught them how to buy rentals. Okay. Because again, people don't buy primary because they want to have portability or not portability, but they want flexibility, right? Because when our kids were young, right after college, we said, hey, why don't you guys buy rentals since you don't want to buy your own place yet? Because they prefer renting, sharing, condos or rentals with their friends. So again, for them, they didn't want to buy a primary because they wanted, flexibility. But we taught them, hey, we need you guys to buy some rentals. So that's what they did, and so they built their wealth, buying rentals. Okay, so again, if it's a choice between one or the other, buying rentals has better tax benefits. Okay, and we'll talk about that in a couple of weeks, but I'll touch on that towards the end. Okay.
And that's in addition to your whatever this you're taking on your primary home as well, right?
Yes. Yeah.
Okay.
They're treated separately. On your Schedule C, you'll list out all your properties, and then you can list out your expenses. Okay.
Only 2 homes are allowed, right? You said only 2.
As far as that limit, right?
Okay. Okay.
Typically,
Okay.
it's the first and second. Yeah,
Okay. First
because
and
again,
second.
in our area, it's typically eaten up by the first one. You don't get 750 on each house.
Okay. Not.
750 total for both houses. Right.
Oh.
So,
Okay.
like in our instance, if we had a house in Half Moon Bay and then one in Newark that we were, because I work here out of the East Bay. My wife likes the peninsula, so hey, somewhere in between, right? But we kept both houses for a while as primary residence, or we can only have one primary, but we were using it as a second home because we had the tax benefits back then. But come 2017, we lost all those benefits. They limited the loan amount and the property taxes. So we said we need to convert into rental. I don't need to have a separate place here. I can just go visit mom, brother, sister. Hey, let me come over, right? If I have to sleep over. So again, typically second and third homes are luxury. Our president, Donald Trump, he has multiple houses because they're all paid for. And what he's done is he's converted into a business owned property so that he gets to stay as a CEO. So again, there are benefits to owning real estate. It's tax planning is one thing, right? There are different reasons why you should own it on your own, and there's reasons why you should own it as a business, and still get the benefits as if you owned it. Okay, tax law is beneficial for realtors, as you'll learn tomorrow. Okay, so Ranjit, if you think more questions, let me ask Barsha's questions
Sure.
first. Barsha?
So, Greg, I have a question about, so how many times we get primary home 250K this tax deductible in
Every 2
life?
years.
Oh,
Every 2 years, right? Because you have to live there and own it for 2 years, right? So every 2 years, every 2.5, 3 years, you can do this all day long, right? So if I know some people who bought houses since 2010 and they sold in 2015, they did it again in 2019, and they just did it again in 2024. At client 3 times, like, oh, 500,000 each time. Now you say, where is that? In the peninsula, because prices increase by more than by close to $500,000 every 5 years because of their price points, right? Okay, so again, if you're buying 200, $300,000 properties, you're not going to be able to get the 250, 500,000 limits. But if you're buying $1.5, $2 million properties, homes have gone up $500,000 in those price ranges. As we shared yesterday, Soranjit's family member, right? They bought for 2.6. 3, 4 years later, it's like over 4 million. So they can sell that and make in pocket 500,000 tax free, right? Or, like I said, there's reasons why people buy primary. There's reasons why people take advantage of the tax benefits of having rental properties. Okay. Remember, you can only have one primary, right? So you can't say, oh, this is a primary for 6 months out of the year. That's a primary for 6 months out of the year. No, because the IRS is going to look at, okay, where do you have your driver's license? You don't move multiple times during the year. So you only have one primary. Where do you vote? Because when you vote, you're supposed to have resided at least a year in that property in order for you to vote in that county or city. Okay. So again, that's how they really find out. Okay. So again, you can only have one primary, just like you can only have one primary wife, right? Or in this case, looks like only me and Henry's here, but or We shouldn't too. But again, you can only have one wife, guys. Right? Unless you're in the different state, those are all different rules. Okay, so one primary, everything else should be rentals, Airbnbs, things like that. Otherwise, secondary, third, fourth, those are all luxury, unless unless you haven't hit your cap yet. All right. As in creator rate, the Section 121, the 250 exclusion, 500,000 per couple, you can do that every 2 years. Now, there is a section in there. Okay, if for instance, I bought a house and then a year later I have to sell. Now, I haven't owned it for 2 years. I haven't lived there 2 years, right? So let's just say I have only owned it for 1 year, right? And lived there 1 year. I can get a prorated portion. Instead of 250, I can get 125,000 per person. If I can prove to the IRS I had an unknown circumstance that forced me to sell. What are the examples? Well, what if I work for Apple and Apple relocates me to another part of the world, right? Or another part of the US. They forced me to move, right? Because my job. Yes. Now, it's the same job. It's not that I Apple has an opening in Florida, so I want to take that job. It's not forced by the employer. Got it? It's not a forced move by the employer. So again, I have to be able to prove that, right? Because I will get audited. Okay, if I claim that exemption. Because remember, everything's automated nowadays, right? The other is a divorce case, right? It's unknown, right? So if for some reason, your spouse is divorced after a year, they might be able to get that exemption. Some people have challenged death, right? Let's say one of the spouses dies. It has been challenged. I don't think that's one of the examples yet. Having, let's say, 5 kids. What I mean is like having triplets, right, or quintuplets, like multiple kids at one time. That's an unforeseen. That has been approved. So if you guys, anybody have triplets, quadruplets, quintuplets, right? If that happens to you and it forced the sale of the property because now you need more space, you can get a prorated portion. Okay, so will the wildfires in LA, if people bought it a year ago and now they have to be forced to sell, the IRS might forgive that too. All right. So again, the rules are changing. So you have to look at the IRS website, irs.gov, and they'll have examples to that. Okay. For California, does anyone know what the website is for the Franchise Tax Board? ftb.ca.gov, right? ftb.ca.gov. That's for the Franchise Tax Board in California. That's where we file our taxes, so you can look at that. And then, of course, irs.gov, right? So just remember the .gov at the end, okay? And then the CA in ftb.ca.gov, okay? Now, let's see. Any questions regarding primary residence? Let's leave that. So you guys know the limit. If you sell and you make money, you get the exclusion. Anything after that, you could be taxed up to 20%, up to 13.3 in the state of California. And then, of course, the additional 3.8% for healthcare, right? What else? Any other questions regarding that before I get to buying? What's the benefits of buying, right? We talked a little bit about it. And we'll talk a little bit about some of the rules. It's 750K, the interest on the 750K. Okay. So let's quickly review in case some of you guys that came late, right? So again, what is deductible, right? So what is deductible, right? So here it is, right? Here's what's deductible. Interest costs, right? Of the first 750,000 loan amount, taxes up to 10K, right? Nothing else is deductible for personal use or primary homes, right? We talked about, how it's what it's applied to, right? So again, any gain that's not exempt from the 250K, here's the tax rates, okay? How to calculate it. We have to talk about, determining basis, right? Of course, IRC code section 121. That talks about the 250. So you guys should know this as a basic information, okay? All right. So now, can anyone buy real estate? Yes or no? Someone asked you, can anyone buy real estate? Yes or no?
You have to be pre-approved, I guess, to
No,
buy.
no, it's not even that. I got cash. Can I buy real estate?
Yes.
It's not. The answer is no. Okay.
Yes.
All right. Anyone above 18 can buy real estate, right? Do I need to be a US citizen
No.
to buy
No.
real estate in US or
No.
California?
No.
No.
So I can be a Canadian and buy real estate?
Yes.
Yes.
Okay. All right. Okay. Yes. Anyone above 18, anywhere in the world, it doesn't matter where you reside, you can buy real estate in the United States. Okay. We're one of few countries that allows that we don't need residency. It can be a second, third, fourth, fifth home for them. You know, we can convert it to rental or leave it vacant. Okay. There's a lot of vacant homes out there where it's like a vacation home for some people. They come here once or twice a year. Sorry, once or twice a year, 2 to 3 weeks out of the year, right? So there are some properties out there, right? And those are what we call luxury homes typically, right? And it doesn't have to be a multi-million-dollar property. Okay. It could be just a single 3 bedroom, 2 bath here, condo here in Union City, and someone just, uses it when they vacation here. Right. So anyone can buy, no residency required. As long as you have the money, you can get the money into escrow, you can own. Now, technically, you cannot own unless you're 18. So, can a 16-year-old multimillionaire who created something buy real estate? The answer is
Yes. Yes.
no, they
No.
cannot. But
But if they are like, uh, what is that called? I forgot the word.
emancipate, right? So, if
Emancipate.
you
Yeah.
have the court, basically separate them from their parents, divorce the parents, right? Because they're what they call emancipated minor. Then yes, the answer would be yes. So, so when I say under 18, the answer could be maybe, right? It depends. Yeah, but technically, you cannot own real estate if you're under 18 because you're not legally able to sign papers. Okay, that's the reason. So if you can convince a court to say, hey, you're an adult, right? Become an emancipated minor. So you're an adult, so you can sign. You have the means to take care of yourself. Then you can own real estate. Okay. Um, let's see. Can a felon own real estate? Someone that came from jail.
Yes.
Yes. Yes.
Yes, you can. All right. So other than that,